We're witnessing something extraordinary in the silver market right now. While spot prices have broken through $100 per ounce for the first time in history, trading at $102 as of January 23, 2026, there's a far deeper story unfolding beneath these headline numbers. What's happening isn't just a price rally, it's the systematic breakdown of the paper silver market, and it's accelerating faster than anyone expected. Let me paint the picture clearly. Silver has surged over 233% year over year, with a 42% gain in January alone. The gold-silver ratio has compressed to around 50 to 1, signaling silver's dramatic outperformance. Industrial demand is at record levels, accounting for 60% of consumption at nearly 680 million ounces, driven by solar panels, electric vehicles, and data centers. Supply deficits exceed 500 million ounces annually. These fundamentals are powerful, but they're not the real story today. The real story is this: paper silver is dying, and it's dying much faster than markets anticipated. When I say paper silver, I'm referring to the entire ecosystem of financial instruments that represent claims on silver without actual physical delivery. This includes futures contracts traded on COMEX, exchange-traded funds, options, and various derivative products. For decades, this paper market has dominated price discovery. The futures exchanges in New York and London have been the authoritative voice telling the world what silver is worth. But that era is ending. Here's the evidence. While COMEX quotes silver at around $102, physical silver in major trading hubs is commanding vastly different prices. In Tokyo and Dubai, physical transactions are occurring at premiums as high as 80% above paper prices, with some deals reaching $130 per ounce. In China, premiums on the Shanghai Gold Exchange have reached 12 to 13% above Western paper benchmarks. Japan is seeing premiums around 60% on secondary platforms. Dubai premiums are running at 40%. This isn't a temporary dislocation that arbitrage will resolve. This is a structural fracture, and it's unprecedented in modern precious metals history. The divergence between paper and physical has never been this wide, this persistent, or this visible across multiple global markets simultaneously. What's causing this breakdown? The answer lies in a convergence of forces that the paper market was never designed to handle. First, there's the inventory crisis. Registered silver inventories in Western vaults have plummeted over 70% since 2020. COMEX saw 33.45 million ounces physically withdrawn in just 7 days in mid-January. That's 26% of registered inventory disappearing in a single week. But it gets worse. Much of what's reported as registered inventory is either non-eligible or already encumbered, meaning the pool of truly deliverable silver is far smaller than official numbers suggest. Second, we have China's export restrictions. On January 1st, 2026, China implemented strict new export licensing requirements, effectively ring-fencing 65% of global refined silver supply for domestic use. China isn't just the world's largest refiner of silver. They've now reclassified silver as a strategic material, treating it the same way they treat rare earth elements or semiconductor technology. This fundamentally fragments the global market. Western exchanges can no longer assume Chinese supply will flow to balance their delivery obligations. Third, industrial demand has become price inelastic. Manufacturers building solar panels or electric vehicles will pay whatever price is necessary to secure silver because the alternative is shutting down production lines worth billions of dollars. Solar capacity forecasts show 665 gigawatts requiring 120 to 125 million ounces. This demand doesn't fluctuate with price. It's structural. It's government mandated in many cases, and it's competing directly with the paper market for available physical supply. Fourth, and this is critical, institutional investors are losing faith in the paper system itself. When futures contracts approach delivery months, traders are now paying premiums to pull forward deliveries weeks early, insisting on taking physical custody immediately. This behavior signals profound distrust. These aren't small retail investors panicking. These are institutions with billions of dollars who've concluded that waiting for contractual delivery dates carries unacceptable risk that the metal won't actually be there. The futures market is showing this stress through backwardation. When near-term contracts trade at higher prices than distant contracts, the market is screaming that silver available for immediate delivery is far more valuable than promises of future silver. This price pattern is the market's way of saying there's genuine doubt about whether sufficient silver will exist for delivery months from now. And lease rates have spiked to 8%, an unprecedented level that reflects the desperation of parties needing to borrow physical metal. Now let's talk about what this means for the paper silver instruments that millions of investors hold. Exchange-traded funds like the iShares Silver Trust operate through complex structures involving authorized participants, custodians, and leasing arrangements. Under normal market conditions, this works fine, but we're not in normal conditions. When physical silver becomes scarce and lease rates spike, authorized participants face a stark reality. They may be unwilling or unable to source metal for ETF creation or redemption. The risk is straightforward. If the gap between physical prices and the net asset value of ETF shares continues widening, investors may demand physical redemption. But redemption of physical metal from ETFs is notoriously difficult for retail investors. The structure simply wasn't designed for mass redemptions into physical form. In extreme scenarios, ETFs can suspend redemptions, force cash settlements, or begin trading at significant discounts to their stated net asset value while the underlying metal becomes unavailable. We're already seeing warning signs. Recent data shows silver ETFs trading at discounts to net asset value, even as physical premiums soar globally. This creates an absurd situation where the paper claim on silver is worth less than the paper's stated value, while actual silver commands massive premiums. It's a clear signal that the linkage between paper and physical is breaking. The leverage embedded in futures markets amplifies these risks catastrophically. Daily trading volume in silver futures often exceeds global annual mine supply. Think about that for a moment. More silver trades on paper in a single day than comes out of the ground in an entire year. This creates massive instability because prices move based on speculator positioning and margin requirements rather than actual supply and demand for metal. Here's what happens during stress. The CME group just implemented a radical shift from fixed dollar margin requirements to a percentage-based system, raising silver margins to 9.9%. When margins increase, traders holding leveraged positions must either post additional collateral or liquidate. This forced selling creates cascading price declines even when physical demand is surging. A massive block trade of 25,000 contracts in mid-January sent silver soaring 20% in a week, prompting the exchange to implement these emergency measures. The result is mechanical liquidation waves where prices crash 10% or more within hours, not because supply increased or demand fell, but purely because of margin calls, forcing position closures. ETF holders get caught in this turbulence as traders liquidate their ETF shares to raise cash for futures margin calls. The paper market drags down the paper-backed securities, even though physical metal is in shortage. Major financial institutions with large short positions face mounting pressure. Firms like JP Morgan, Citigroup, and Bank of America must either post billions in additional collateral or close positions in a market with no liquidity. We're hearing reports of margin stress at major international banks. The CME's 50% margin hike was explicitly about protecting the clearinghouse from potential defaults. When the exchange takes such drastic action, it's acknowledging systemic risk. Now, here's where this gets truly significant. When COMEX and the London Bullion Market Association cannot deliver physical metal and resort to cash settlement, their role in price discovery erodes. The more frequently they settle in cash instead of metal, the more the market treats their quotes as financial prices disconnected from physical reality. This shifts price leadership away from New York and London toward markets like Shanghai and Hong Kong, where physical supply and demand dominate. This is precisely what Wall Street fears most. For decades, dollar-denominated paper markets in New York have controlled silver pricing through leverage and derivatives. If that price leadership moves to Asian physical markets, Western financial institutions lose their ability to influence prices. The control mechanism breaks down, and that transition is happening right now. What does this mean practically? It means the price you see on financial websites increasingly doesn't represent the actual cost of acquiring silver. When physical trades at 30 to 80% premiums above spot, the spot price has lost meaning. Industrial users are already bypassing Western exchanges entirely, going directly to Asian markets and paying whatever price secures metal. They've concluded that paper markets can't reliably deliver. We're entering what analysts call the physicalization event. For every ounce of actual silver in vaults, there are estimated to be hundreds of paper claims. When those claims get called for delivery simultaneously, the system cannot perform. It's mathematically impossible. Some claims will be settled in cash. Some will face suspended redemptions. Some will simply fail to deliver. The comparisons to the 1980 Hunt Brothers silver squeeze are instructive but incomplete. Back then, the COMEX implemented Silver Rule 7, restricting trading to liquidation only to break the Hunt Brothers cornering attempt. The exchange could act decisively because the problem was concentrated in one family's positions. Today's situation is far more complex because it's driven by genuine industrial demand, strategic government stockpiling, and systemic supply shortages. There's no single position to target. The pressure is structural. Regulators face an impossible situation. The Commodity Futures Trading Commission is under pressure to investigate price manipulation allegations against bullion banks. But how do you maintain orderly markets when physical supply cannot meet demand and paper claims vastly exceed deliverable metal? The market is already bracing for potential force majeure declarations, where COMEX officially admits it cannot fulfill physical delivery requests. If that happens, the paper price would likely collapse or cease to exist as participants flee to physical markets. Think about the implications. Investors holding paper silver could see their positions settled in cash at prices that have no relationship to actual metal values. Your contract says you own silver at $100 per ounce. The exchange declares force majeure and settles you in cash at $100. But physical silver is trading at $130 or higher. You've just lost 30% or more of your value through no fault of your own, simply because the system couldn't deliver what it promised. The historical precedent from March 2020 should alarm anyone in paper silver. During the initial COVID crisis, physical silver premiums hit 50 to 100% above spot, while ETFs traded at discounts to net asset value. Some precious metals, ETFs temporarily suspended new share creation when physical silver became scarce. Physical holders could sell at massive premiums. ETF holders faced redemption suspensions and couldn't access physical metal. The current situation is exponentially worse because inventory levels are far lower and deficits are far larger. Looking at the path forward, analysts are projecting $120 silver by end of 2026 with potential for $150. Citigroup specifically forecast $100 by March and $110 by mid-year. These aren't speculative moonshots. They're conservative estimates based on structural deficits that cannot be resolved quickly. Industrial demand keeps accelerating. Mine production grows only 1 to 2% annually, and 70% of that is byproduct production that won't increase unless base metal prices justify it. But the price target isn't the critical question. The critical question is whether the paper market survives in its current form. When the gap between paper and physical persists at these levels, when major exchanges implement emergency margin measures, when China walls off most global refined supply, when lease rates hit 8%, when inventories drain at record pace, we're not looking at volatility. We're looking at systemic transformation. For investors, this demands immediate reassessment. If you hold paper silver through futures, options, or certain ETFs, you're exposed to counterparty risk, redemption risk, cash settlement risk, and the risk of permanent disconnection between your paper value and actual metal value. The convenience of clicking a button to buy or sell doesn't compensate for waking up to discover your claim on silver is worth 30, 50, or 80% less than physical metal. Physical silver ownership has costs: storage, insurance, higher transaction spreads, less liquidity. But physical ownership has zero counterparty risk. Nobody can declare force majeure on metal in your possession. Nobody can suspend redemptions. No exchange can settle you in cash. You own actual strategic material that governments worldwide now classify alongside critical technologies. The market is fracturing into two distinct tiers. Paper silver, governed by financial market dynamics, leverage, and margin calls. Physical silver, governed by actual supply scarcity, industrial necessity, and strategic competition. These two markets are decoupling, and the gap is widening, not narrowing. 7 consecutive years of structural deficits have drawn inventories to crisis levels. China's export restrictions fundamentally change supply dynamics. Industrial demand has become price inelastic and government mandated. Central banks in emerging markets are accumulating silver as monetary reserves. These forces aren't temporary. They're structural shifts that redefine silver's role in the global economy. The paper silver market was built for a world where supply was abundant, where Chinese refineries freely exported, where industrial demand was modest and price sensitive, where leverage could dominate price discovery. That world no longer exists. The system is trying to operate under conditions it was never designed for, and it's failing, visibly, measurably, acceleratingly. The breakdown we're witnessing represents the first major failure of a paper-based pricing mechanism for a critical industrial and monetary commodity in the modern era. This isn't about speculation or manipulation. This is about mathematical reality. When paper claims exceed physical supply by orders of magnitude, and that supply becomes strategically restricted, the paper system cannot function. Price and value have officially diverged. The number on your screen is increasingly meaningless. What matters is whether you can actually acquire and possess the metal. And for those holding paper claims, that question is becoming harder to answer with confidence. The silver market of 2026 is fundamentally different from anything we've experienced. And those who recognize this reality and act accordingly will be far better positioned for what's coming next.